We're diving into an in-depth analysis report today, focusing squarely on the recent NVDA correction. It's all about the critical technical levels to watch this week.
Yeah, this one is timely. The material is tackling that, 17 or 18% drop from the 212 high?
Exactly. It's got the stock sitting right at that huge psychological 175 level. I mean, we're right on the edge of that 20% line that people start calling a bear market.
A very high-stakes moment for the stock for sure.
And the material is excellent. I want to say that up front. It maps the support and resistance zones so clearly. But, there are ways we can elevate the core investment thesis.
I agree completely. And I think we can start with something we see a lot in these kinds of volatility reports, which is trying to merge two very different timelines.
The analysis presents a powerful mixture of immediate technical levels and future fundamental support, but could more explicitly connect these two distinct time horizons to strengthen the core investment thesis.
Right, so the bull case in the material, it leans heavily on what it calls the fundamental safety net.
Which is all about those huge future catalysts, the Blackwell chip cycle kicking in, early 2026, and revenue projections over $130 billion?
Mm-hmm. That's the big institutional narrative, no doubt. But here's the weakness. The analysis never really builds a logical bridge. Why do these massive, distant events justify defending 175 or 170 this Monday?
That's the question. I mean, we all get the concept of smart money buying the dip, but the connection between that long-term idea and the specific intraday defense it's just implied. It's not really argued.
Exactly. The listener needs to know how institutions are defining that dip. Is it just an arbitrary number? Or is there some math that links it back to their long-term fundamental view?
For sure. So I think the suggestion here has to be integrating that fundamental rationale right into the technical support discussion.
Yes, we need to see how these big funds are quantifying the current discount relative to that, that far-off outlook. That's what moves this from a simple buy the dip call to something with real credibility.
Okay, so a concrete example. The analysis mentions those Bank of America price targets, some up around 275. That's a huge piece of data just sort of floating there.
Right.
So why not add a short section that actually models the scale of the massive discount? You could frame 175 as a specific percentage retracement from those consensus targets.
Oh, that's a great example. Saying something like $175 is down 36% from the consensus high target of 275. That is so much stronger than just calling it a massive discount.
It turns a feeling into a metric, right?
It really does. And you can do the same thing for that 170 emergency floor. Instead of just saying it's a historical volume level.
Which is important, but...
But you could also connect it to, say, a multi-week volume profile or a specific moving average that big institutions are known to watch, and then describe how that technical zone might be the precise entry point they've calculated, working backward from those 2026 revenue numbers.
Now you've closed the whole logical loop. You're showing the math that turns a distant promise into immediate tradable price action.
Absolutely. It transforms the whole thing from a good thesis into a tactical roadmap. When the timelines feel separate, the analysis is fractured. When you connect them, the conviction just goes way up.
Okay, so building on that point, the idea of providing full context, let's look at how the analysis actually introduces the correction itself.
Yeah, my focus here is really on completeness and the strength of the narrative. To maximize the predictive power of the strategy, the analysis should provide a concise summary of the underlying drivers that caused the recent 17-18% correction from $212, rather than treating the drop as purely technical.
I see the issue. Yeah, the analysis is very clear on where the stock is now, 175.02, and where it needs to go, which is reclaiming 181. But it completely skips the context of what actually triggered the slide.
And that's the weakness. I mean, the bear case section even mentions macro factors, so it implies they're not technical selling pressure, but it never defines that force.
Right.
If the bull thesis is supposed to counter the bear threat, you have to name what you're fighting, Was this a real fundamental concern, or was it just profit-taking?
It changes everything. A drop from options expiration is one thing. You'd expect resistance at 181 to just be friction. But if it was driven by macro fears about rates, then reclaiming that level is a much, much bigger statement.
Exactly. So the suggestion is pretty straightforward. Just integrate a brief, high-level summary of the correction's root cause right into the setup section. It grounds the whole technical analysis in a real market narrative.
Okay, so for an actionable step, the piece could just add one single powerful sentence right before it defines the pullback.
Like what?
Something like, this 17-18% retracement appears to be primarily driven by A, typical end-of-year profit-taking, and B, broad NASDAQ weakness rather than any fundamental change to the NVDA story.
Yes, that one sentence gives you immediate clarity. It just elevates the whole analysis.
And then that 181 resistance zone has so much more meaning. Reclaiming it isn't just a technical event anymore. It's confirmation that the force that drove the stock down has been overcome.
It gives you a reason why you're watching 181, not just that you should be watching it. And that's what turns simple chart reading into, robust market interpretation.
Let's shift our focus now to the practical side of this, particularly how it relates to execution and risk management.
Yeah, this gets in the audience alignment. The practical verdict section is sharp and decisive, but its actionability for risk management could be significantly strengthened by integrating specific context regarding proportional risk exposure relative to the established support levels.
Okay, I see exactly what you're going for here. The strategy section is great at setting the entry targets. You have Scenario A, reclaiming 176, and Scenario B, breaking 180.
And it has that crucial warning for Scenario C. If it crashes through $170, wait for stabilization. Do not catch a falling knife.
Right, a classic line.
But the weakness is so obvious if you put on a trader's hat. It gives you these clear entry ideas, but it totally fails to outline the implied risk-reward or suggest a concrete stop-loss for scenarios A and B.
And with the stock hovering just a few dollars above that critical 170 floor, defining your risk isn't optional. It's everything.
It's vital. Without defined risk, the strategy isn't complete. It's potentially reckless, honestly. So the suggestion has to be to frame those entry points within a clear risk management context.
Help the user quantify their risk, right? They need to know the size of the bet they're making relative to that floor breaking.
Exactly. Let's get really actionable here with some examples. For Scenario A, that potential long entry if it reclaims 176.
Okay.
You have to suggest a concrete stop loss. Maybe it's based on the low of the day, which the analysis identifies around 174.60.
So you could phrase it like this. For a Scenario A entry at 176, your risk is defined by a close below 174.50. That establishes a tight, quantified risk unit. $1.50 per share against a potential move back to 181.
Precisely. That immediately translates the strategy into something a trader can actually use to size their position. That's what an actionable strategy is.
Okay, so now let's go back to Scenario C, the falling knife.
Yeah, just saying wait for stabilization below 170, it just leaves people feeling directionless. It usually leads to panic.
It's an indefinite holding pattern.
It is. So instead of just warning them, we should offer some alternative, more robust levels where stabilization might happen if that 170 floor does break.
Give them a plan B, or a C and a D. Identify the next major support zone from a longer-term chart. Maybe it's the 50-day moving average, or a big volume node down around, say, 165. This gives them concrete options beyond just waiting around. It keeps the analysis actionable even in the worst-case scenario.
That's the difference between caution and paralysis. Giving defined stabilization targets below 170 ensures this remains a robust strategic tool, no matter what happens.
Yeah, for sure. So we covered 3 really critical areas today to elevate this analysis report into a truly superior strategic document.
Right, we talked about integrating those long-term fundamental safety nets, the Blackwell cycle, that huge revenue target directly with the immediate technical defense.
Right. Translating institutional psychology into a hard number. A quantifiable discount metric.
Then second, we focused on strengthening the whole logical structure. The analysis needs to contextualize the cause of the correction.
Which gives a necessary narrative driver to the whole thing, and makes reclaiming 181 feel like a real market victory.
And third, the critical need to bolster the actionable strategy with explicit risk management. That means defined risk units, clear stop-loss placements, especially with that 170 floor so close.
The quantified discount, the narrative context, and the explicit risk framework, it can achieve so much more analytical depth.
At the end of the day, we're asking for a shift from just reading a chart to understanding the institutional psychology that's driving that chart. So take these 3 ideas and see how they can transform the power of your next submission.